Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. So, in last week's Market Insights, we talked about how does the Fed print money. This week, we'll try and address what does it all mean when the Fed prints money. So, first thing we probably ought to address is there any limit on how much money the Fed can print? And the answer is technically no, but practically yes. And what we mean by that is if you were to go back to 1972, there was a mechanism called the gold window. And the Fed was actually required, if somebody showed up with $35, they would have to give them an ounce of gold. And that created a limit on how much money the Fed could print. Because if they printed too much, then a lot of people would present their $35 and there would be a run on Fort Knox, which is where we kept the gold. And guess what? In 1972, that's exactly what happened. Richard Nixon, the president at that time, was trying to fund a lot of expenditures domestically, a lot of expenditures during the Vietnam War. It's what he called his guns and butter strategy. And the Fed was printing a lot of money to make all this possible. And a lot of people wanted their ounces of gold for $35. So Richard Nixon said, we're closing the gold window. We're no longer going to let you do that. And that essentially lifted the limits on how much money the Fed could print. And as you might imagine, they kind of went nuts for the next several years, and they printed a lot of money. And if you were old enough to remember, you'll remember the 70s were a time of pretty high inflation. Inflation averaged, 8, 9, 10% pretty consistently that entire period of time. So the Fed got some new leadership, a guy named Paul Volcker. He raised interest rates, he stopped printing money, got inflation under control, and ever since then, the Fed has been trying to balance the amount of money that they print so that they keep inflation somewhere around 2%. So this was the policy that the Fed followed for most of the last 35 years, until the big global financial crisis of 2008.
The industry leader, by the way, filed for bankruptcy. The company immediately, good time for my voice to go, fired 3,200 workers. The manufacturing index also fell in the month of March, warning that economic growth could slow. Now, the Institute of Supply Management also reported a rise in prices.
I'm going to call my mom.
After that terrible economic disruption, unemployment hit 10%. The Federal Reserve felt like they had room to print a lot of money without creating inflation, because when a lot of people are unemployed, that depresses the overall inflation rate because unemployed people can't buy things. So the Fed first took interest rates to zero, and they had to print a lot of money to make that happen. When that didn't get the economy going fast enough, they then printed more money and they bought mortgage-backed securities. They bought 10-year and 30-year bonds because what that did is it lowered interest rates on the things that really matter to U.S. consumers. Your mortgage, your car note. It made it easier for us to buy homes and cars, and that helped accelerate economic growth. Unemployment slowly came down till by September of 2019, unemployment was down to 3.5%. Now, by September of 2019, the Fed had long since stopped printing money. And they found themselves in a situation where the economy was doing well. There was a big budget deficit. About $1.2, $1.4 trillion was the expected budget deficit. The housing market was doing well. The car market was doing well. People were needing to borrow a lot of money at the same time that the U.S. government was needing to borrow a lot of money. And that was putting upward pressure on interest rates. Now, President Trump did not like that, and he tweeted his unhappiness to the Federal Reserve in no uncertain terms. And in fairness to Fed Chairman Powell, we were seeing interest rates potentially climb just as American workers were finally starting to get some wage increases. So, to prevent interest rates from rising, for the very first time with unemployment really low, for the first time since the 70s with unemployment low, the Federal Reserve started printing money and buying bonds. And they did it to help finance the budget deficit and hopefully keep the economic expansion going. Now, that became $1 trillion a month in March and April of this year. As COVID-19 devastated the economy, the Congress and the President agreed on a $2 trillion COVID-19 recovery package. That needed financing. The Federal Reserve printed the money to make it possible. There's another potential COVID-19 stimulus package sitting out there. The Federal Reserve is standing by to print the money to make that possible. It could be by the end of 2020, the Fed will have printed as much as $5 trillion. Something we just have never seen before in history. And the obvious question that people are asking is, what will that mean? Well, the most obvious thing, and the point we've been making ever since the Federal Reserve started printing money back in September of 2019, is if the Fed's going to print money when the economy's strong, the stock market's probably going up. And we started saying in March of 2020, when they ramped up the printing presses all the way to $2-3 trillion, if they're going to print that much, even though the economy's weak, the stock market's probably going up. And we think that the fact that they're probably going to print still more money in the months to come, that's a support underneath the stock market. Because as we explained when we described how this mechanism works, when the Fed puts money in their checking account, that money ultimately gets into financial markets and it supports asset prices. But what about inflation? What about what happened the last time the Federal Reserve printed money this way back in the 70s? Could we see a repeat? And the unfortunate, honest answer is no one knows. Because for the last 6 years, Japan has been deliberately trying to create inflation. And they've been printing a lot of money. And most economists thought that they'd be very successful in generating some inflation, but they haven't. We don't know why. It could be because they have an aging population and demographics just depress inflation. It could be because of technology. It could be because of globalization. If prices rise in one country, you just import more from another country. We don't really know. What we do know is that the room to print money is more than it was in the 70s, and the Fed feels comfortable with this dramatic influx of liquidity into the U.S. economy. Will it prove to be too much? We will have to find out. Our concern is that the $5 trillion thereabouts that they print to get us through 2020 and COVID-19 is probably not the end of the money printing party. Once COVID is passed, unemployment will fall, but it's probably not going to fall all the way to 3.5%. And remember, the deficit was $1.2 trillion when unemployment was that low. Let's say it quickly drops to 5. That's a pretty optimistic expectation. And at 5% unemployment, the budget deficit could be more than $2 trillion. We still don't have the taxes or the money available in the economy to finance that kind of deficit. The Fed will probably have to continue printing the money to provide the financing for those levels of deficits. We could see money printing in the $2 trillion range for several years to come, because whether you're a Republican or a Democrat, President Trump is not talking about budget deficits and the need to get them under control. He's talking about more tax cuts. And Vice President Biden for the Democrats, he's talking about tax increases, but not to lower the deficit, to fuel more spending. So neither candidate is really interested in doing anything about the budget deficit, which means we're likely to see more money printing in the years to come. And we'll have to worry as to what will be the tipping point. How much can be printed before we start seeing inflation? We understand it's definitely more than the 70s, but is it infinite? I don't think so. So if you look at the way we're positioning our portfolios, we're positioning our portfolios to benefit from the kinds of stocks, the kinds of assets that will benefit from an economy awash in liquidity. If and when we see inflation, we will have to adjust our strategies. Thanks again for tuning in to Market Insights. We hope you found it interesting and informative. If you'd like more of our research, you can subscribe to our YouTube channel below, and you can find additional publications at caravelconcepts.com. Thanks.